there's an important lesson here that you need to learn. That will make you a great investor. And it will help you not only make money, but prevent you from getting wrecked. And I'm not here to rage against these analysts and they're all on the wrong side. Listen, the data was great. The data was fantastic. In phase 1, phase 2, it made sense compared to the other drugs. Everything checked every single box. And really, this was almost as certain as a guarantee that I saw. That's why I love the stock and I recommended it last time. But just the phase 3 trial was pushed out. I'm like, we're going to be sitting this thing. It's going to trade sideways for a while. And it did. And then, went higher and then came back in. But the lesson here is the expectations. So everyone, and I mean everyone familiar with this drug, analysts, doctors, insiders, hedge funds, thought this drug would easily get phase 3 approval. Everyone. Companies were modeling before they received phase 3 approval, before they could sell the drug and get the full approval. They were modeling for $5 to $9 billion peak sales. I think one company had $3 billion, but around $6 billion was the average in peak sales for this. And only one analyst had a sell rating, which they're undisclosed, which means they're probably a very, very small fund. Because, I have access to Goldman and JP Morgan, Jefferies, all these reports. They didn't have a name on it, so it's probably a small boutique firm. But even with that sell rating, the guy had a $50 target, so expectations were kind of high as well, since that's where the stock was trading just before the news hit. He should have a neutral rating on it. Now, I explained how expectations work on Tuesday. Since there's a ton of risks in the market, and I'm looking at the market too, and I love when I can, this is why when I look at things, and I don't care what side you're on, a political aisle or whatever, for me, if the data changes, I change immediately. And I was leaning bearish. I'm like, wow, there's so many risks in the marketplace. I saw amazing opportunities in small caps. I've said, listen, one of the great buying opportunities, not in the Russell, not buying the Russell, but just there's so many names that are down 40, 50, 60% from their highs that don't deserve to be down that much. They have strong balance sheets that are, just great right sectors. The earnings, they reported the last 2 quarters were great. They raised earnings expectations. Now they're cheaper than ever, down 20, 25, 30%. And, a lot of great buys here. But if you're looking at the macro point and you're looking at what's going on in the markets, what do you have? UK, Russia, which is all over the place. Are they invading? Are they not? What's the definition of invasion? Is it an invasion? Who knows, right? We just know that we're being told to hate Putin and they're a threat to the world. While China is perfectly okay, and they're not a threat to the world at all, even though they killed millions of people, right? With COVID and genocide and all this shit and how terrible they are in CL technology, we'll always deal with them because we do business with China. We don't do business with Russia, right? So that's why we're very, very nice to China, even though China's a much bigger threat than Russia. Much bigger threat than Russia to us, right? And to the world. That's okay. But it's all about money, right? Everything revolves around money. That's okay. So you got UK-Russia fight. You got the Fed tightening, which who the hell knows how much they're going to tighten because it was 3 rate hikes going predicted November. December was 4. Then they went up to 6. Now, just a couple months later, again, since November, you have JP Morgan saying there's going to be 9, which we talked about, Daniel and I yesterday. 9 rate hikes. So no one knows what the hell is going on. No one knows how much they're going to raise. We all know they're behind the curve. But inflation hasn't slowed. It doesn't slow. It might be 9. It could be more. I mean, you need inflation to slow, and we're not seeing that. It doesn't help with the Russia crisis in Ukraine because oil prices are going higher, and we have higher oil prices. That results in almost every single company. That impacts every company, every family, and prices, to make up the difference, you're going to raise prices even higher, right? So they look good. Then you talk about peak earnings. We just came back from COVID, a ton of money flooded into the system. Now it's going to be less leverage. Rates are going higher. It's not as easy to borrow money. The 10-year higher, mortgage rates are much higher. Still relatively low historically, but much higher. I mean, I just closed my house yesterday. I was lucky 4 months ago. It's 4 or 5 months this process took, which is a joke. It was a construction loan, but I closed at 3.25, and I think pretty sure they're over 4% now. It's a big difference. Especially with my house. I'm buying a $60 million house. I'm kidding. I wish. Need a couple more of you to buy some more subscriptions for that. But it's a significant difference, no matter how much the price of your house costs. Then you have inflation just out of control everywhere. Commodities everywhere. Inflation continues to be out of control. And again, higher energy prices on the horizon, which that may lead to even higher inflation and higher energy price on the horizon because, massive cutbacks, not as much drilling, and also because of UK, Russia, and they think turning off a pipeline is good news, right? They think they're punishing Russia, who's one of the largest, if not the largest, right? Now they're the largest energy producer in the world, just surpassed us. I think it's like 12 million barrels a day, whatever it is. So higher energy prices is great for them. They have a surplus. That's awesome. So you're going to shut it off, which creates higher inflation for the rest of the world. That's punishing Russia. Not to mention Europe, Germany, who's shutting that pipeline off. I mean, Europe receives 40% of the natural gas supplies from Russia, right? So, yeah, it's just funny how all this works, but where is it going to go? Who knows? But look at all the risk in the marketplace. What are the positives? Not a lot of positives, not crazy. But you know what? I read a piece, which was really, really good, that made a lot of sense. And I brought it up to you guys. I brought it up to the, this was on Tuesday's podcast, where if you're looking at CTA exposure across, all sectors, and CTA stands for Commodity Trading Advisors. So these are the biggest investors of funds that trade futures and options, and where they lean on each side is a pretty big deal. Again, we're talking about expectations. This is the lesson I'm going to try to teach you guys. So CTA exposure across all asset classes, right? The start of the year, just equities. When I say all asset classes, equities, bonds, forex, gold, oil, copper, everything. But equities in general, these funds were 40% long equity. This is the start of the year. We're only in February. Today, that's negative. It's negative, around negative 8%. That means they have a short position. And it's big. The last time it was at this level was June 2020. And what happened then? The markets really took off. But you see, and when you look at the chart, and if you want to follow along on Curzio Research YouTube page, I'll show this again. And you're looking at that almost every time this line has come down to, it's like negative 8, close to negative 10, we've seen the markets rebound tremendously. Why? Because all these funds are leading short to the point that their overall exposure, not just equity, so equity, bonds, forex, gold, oil, and gold, and copper, is their long exposure just 28%. Throwing a lot of numbers at you, but hear me out. At 28% net long exposure, that's the lowest since 2010. And what happened since then? The markets had one of the biggest roars that we've ever seen, right? The biggest bull markets probably in 30 years, about 30 years. So I provided this chart. I think it was to Curzio Venture Opportunities. I don't know if I put this chart up for, which is our one of our most expensive products, but I don't know if I put this chart up on Tuesday, but I just talked about it a little bit. But now you saw it, and I put some notes on the bottom of it. Again, that's on a Curzio Research YouTube page. But again, I know most of you listen to this to iTunes, and I'll explain it to you. The point is that 20% net exposure, lowest since 2010, and you're looking at what happened. The markets absolutely surged. And when they surged, what did these guys have to do? They all had to cover their positions, and you see the market absolutely take off. So when you're looking at all these risks now, even smart money, again, is leaning really hard in one direction, and that's shorting the markets, betting for a bigger downturn. That's where we are right now. And that's usually a contrarian indicator. Because when we look at Kodiak, they were leaning the other way. Positive, extremely, extremely positive, which explains why the stock's down 80% in a day to $10, even though they have around $13 in net cash on their balance sheet, as everyone is selling the stock at the same time. That doesn't mean you should go buy because it has $13 a share in cash and it's $10 because that's right now. And they're going to continue to use up that cash, and maybe they have further studies, and that cash position could go down to $8, $7 in 6 months from now. But right now it's $13 in net cash, not the reason that you should just go in and buy, because their number one drug to target the biggest market just received very bad results. And those results, I've seen results come in and they question them and say, okay, well, you know what? We need more. This wasn't, we need more. This was like, this ain't going to work. This was almost as negative as you can get. And they have other applications for small markets, and maybe they do better in there, but it was just nothing. Like safety, efficacy was off. It was just, they required more dosage. It didn't mean anything. Inflammation and pain, they didn't expect any of that. None of that showed up in phase 1, phase 2. But now what happened? Everyone caught on one side, selling at the same time. And you see the stock crash. How often do you see a stock crash 80% in one day? That only happens if everyone's leaning to one side. Now, let's flip that. Because all we need to see is just a small positive where maybe inflation moderates or tensions in Russia, UK ease. Or the Fed says, hey, we're not going to be as aggressive when we tighten. Or maybe oil prices fall 20% from these levels, which result in, inflation moderating a bit. If that happens, every one of these fund managers are going to rush to cover their shorts. So you're not going to see the market rebound like 2-3%. You could see it pop 5-7%. And it could happen in a week and a half. Because that's how short they are. This is unprecedented. I wouldn't say unprecedented, but this happens rare. It's not often when they're this net short everyone, to the point where BlackRock just came out yesterday and said, hey, we're adding to our positions now. We think there's incredible opportunities. So when we're talking about all these risks, it usually means that they're priced in. And yes, there's a lot of them. And yes, you can't see too many positives other than there are companies that have pricing power, but there's companies getting it done. Google, Apple got it done. AMD got it done. And that's technology where a lot of technology stocks are getting nailed. The reopen trades, look at those numbers that they posted. Look at the oil companies. They don't have to do anything and they're getting it done. Just oil prices are going higher and higher. And Pioneer just hit an all-time high. Not a 10-year high or 8-year high or last time oil prices were over 100. So there's things that are working, and a lot of names are down that don't deserve to be down. But when I see something like this, expectations are such a big deal when it comes to stocks. And that's why you saw during COVID, when COVID absolutely crashed, expectations were low. You could have bought almost anything in April and you would have made 200%, 300%, 400%. Outside of maybe Boeing or, a couple of companies as he went up 100%, not 100% from its low. I think it went down to 90 and then to 140, 150 or whatever it went. But a lot of these companies that got destroyed, that's the opportunity. And you get that opportunity if you're a smart investor and you're hedging yourself, which is why I was pushing that product, which is money flow traded with Ginia, which a lot of people didn't take us up on, which is cool. That's okay. I'm just telling you, that's how the professionals invest. Because when the market crashes, most people get destroyed. And instead of getting destroyed like you did in COVID and going, holy shit, maybe if I hold on, and you did okay. A lot of people sold. But imagine if you made money and your portfolio was, say, $50,000 and you had puts. So your long positions got wrecked, but those puts just took off. And say if your portfolio went from 50,000 to like 55, 60,000. Now you're sitting at the bottom of a market, one of the best buying opportunities, while everyone's like selling, running to the exits, screaming fire, and you're buying shit at the ultimate cheap price. That's how you make a fortune. You want to be buying when nobody wants to buy.